Okay, hello, everyone. It's been about two, 2 weeks since my last broadcast, so I am just dialing everything in right now. Just give me a second, because I'm going live on like many platforms. All right, and go. Okay. All right, so that should be live. Let's see, doesn't look live on Twitter. Let me see. Yeah, I needed to click start. No. Hmm. Oh, it's going to start at 9:30. Oh, interesting. Okay, fine. All right. Hello, everybody. Let's see. Let's take a look at the market. Yeah, the market continues to move up, but the thing is, it's on descending volume and not able to draw. This is strange. Hold on. Stuck, not able to draw. Key command? Annotator. Oh, did I quit it? Oh, I think I quit it. Okay. Let's go back to the annotator. Oh, that's why I couldn't type earlier. I was in the annotation mode. Now I got to remember what's the name of the annotation app that I use and relaunch it. Let's see. Nope, I don't use MonoSnap anymore. What is that called? See, this is what happens when we haven't been streaming for a little while. But we'll be ready by market open. I just gotta find my annotator because I want to show you something. Okay, well, I can't figure it out. So what I'm going to do is I'm going to go to startup items because it's definitely in there. Is it Presentify? Name could be. Right, let me try that. Maybe that's why I didn't think it was it because it's kind of a weird name. And now if I press Control A, and now I get it. Okay, good. All right, so look at this. The volume here compared to all the volume from before is low. So when we're moving up on softening volume, it means the upward move is not really true or reliable. And then we have heavy down volume, obviously, on that last push down. So what we want to see is some pullback like that, but we want that pullback. We want to compare it to this pullback volume, and we would like the volume to be low. We like that volume to be low when it does that pullback. That's what is called a Wyckoff retest signature, and it would mean that we're no longer really in a downtrend. That this is the bottom, and you need to wait that long in order to really be able to say that. So it takes a while to figure out the market sometimes. You don't always get, big, huge capitulation like we got here back in April 9th was pretty obvious with this massive retrace on the on some of the release of the tariff tensions. But then, even then, it took several days before we really truly got out of the out of that zone. So market wise, I am actually a little bit allocated into Shopify, and one of my students got into TSM, kind of similar, like overall signal, which is this low with a bit of a higher low, and then pushing out and up. Very nice. Same thing on Shopify. See, you have that pullback, and slightly different um, surgically, but very similar. So stocks like that are looking good to me right now. That are shaping up with higher lows over here. Higher low. That's going to be critical. Critical. I wouldn't even touch anything that doesn't have a higher low sort of definitively put in. And that's one reason why I kind of shy away from TSM is the higher low here was a single candle signal, which is fine. But I really liked, from personally, I like the double candle signal of Shopify. It really definitively says, okay, we've got the pivot low in there. It's not just a doji bounce and we're chopping around like if you really look at it over here. You have doji, hammer, a little doji, a little doji. There's a lot of dojiing around over here, and so I'm not quite sure how soft that bottom is. This is definitely a good sign, though, that all that lower price action was on low volume compared to before. So that's a good sign. TSM looks good, and the semiconductor submarket industry also looks great. Either one. I'm not stock market news. No, that's not me. But I think I know who you're talking about. Anyway, so I'm in Shopify, and then I'm also in Cat, but really don't love the idea of getting in way up high up here, although it works sometimes, but the minority of the time. So where did I put my stop on that? Yeah, down at 566, I think it was down here. So long as price can stay in this general area for a little while, then I'll be able to hang out with that allocation, and we'll see where it goes from there. It'll be nice if it takes off. So sometimes you have to expect that you don't have the timing right. You should almost always expect you don't have the timing right. If you had the timing right, you would have no reason for a stop. So the whole reason you're putting in a stop is because you're just not sure if things are going to just go up from here and never come back down. So, you know, um, sort of like this is a great moment to get in, is a good confirmation, but probably could have been more prudent to maybe wait. It's a really strong stock and showing really strong signs. So I think it's going to generally at least stay up in the upper area of that candlestick from here and then move from there. Normally, I would not even trade Caterpillar. Normally, I would not even touch it because it's probably a sub 3% ADR. But it is a 3% ADR, and yesterday it put in a 5%, and the ATR on it yesterday was 5%, and it's around 3% as well. So, um, it's heating up. This Caterpillar is doing something unusually strong, and you got to pay attention when that happens. All right, the market's opening in 1 minute and 10 seconds. So let's see what it brings us. So, but those are the two positions that I'm sort of in right now. I'm also in Selk. I have um, what is it? Selcuity. Selcuity. I am on a free roll at this point in that position after having profited greatly. I've now left it on as a free roll, and it continues just to do outstanding. Yeah, original entry was right there. It was basically like an EP style entry at the top at the end of the day on this Bible gap up day back in July. And then I was able to just hold it and take my systematic profits and techniques for holding to continue to hold, and it just kept going. Another Bible gap up and kept going, and eventually I free rolled it, and now it's just running on purely on profits. And every now and then, if it's made a lot of progress, I take off a tiny piece. All right, market's opening now. Did you? Okay, you're gonna hear a lot of bing binging for a minute here. Those are just all my alerts popping off. On a good day, you might get 30, 40, 50 alerts going, bing, bing, bing. But on a not so great day, not so many alerts will be popping up. No, nothing good on NVIDIA. Let's see, WWR. So the market is open. We're going to see which way everything goes today. SNDK, no. Wilden, no. AGX, no. DK, this has triggered multiple times for me. I tried to swing at it and a miss. Hello, yes, nice to see you. STX, oops, I got to type that in because I just closed the alert. STX, this is pretty cool. It took a fuckload, a ton of programming. You couldn't believe to create these wispy dotted trailing marks, which sort of like hold you in or out of a trade until it breaks them. Um, there's other indicators similar to that, but this is really dialed in, and it's sort of an excellent alternative sell point or even an entry point. That's really what I liked programmed it for was, with this line, it's coming back, it's in a pullback, and then when you get a candle closing above that, that could potentially be an entry. What was that one? TSM. Like, for example, let's go to TSM. You can see the little trailing line. Let's see. Yeah, see the trailing line, it keeps going, it keeps going, it keeps going. And then you had this crazy day. But yeah, after that, it was essentially an entry. And technically, it would have gotten you in at 275, and it's now 293. So that's just crazy. Really, really cool. Shopify. Let's see how Shopify is doing off of the open. Okay, off of the open, it's just neither here nor there. Let me go over to the market. Let's see how the market is moving. All right, we gapped up open a tiny bit, and now we're pulling back just a little bit. That's totally normal. We're now filling the wicks. We're filling the wicks of the prior day and have done so. And so then it's probably going to soften and then maybe turn around and either turn into a chop day or it's going to actually go up. So we'll see. No need to guess. We'll see. Same thing on S&P 500. And now over to Caterpillar. And I like being in Caterpillar in addition to Shopify because Caterpillar is an industrial, and industrials can move in contrary motion somewhat, or definitely independently to growth stocks and general stocks that you expect to go up. So it's kind of a semi hedge. Um, keeps it keeps my allocations nicely sort of protected. It's not necessarily, I wouldn't call it like diversified in the classical sense of diversification, but as far as risk is concerned, it's sort of like definitely kind of an asset risk diversification. It's gonna the more assets you can be in that act independent of each other, the safer your total risk. So you can read about that, learn about that through Ray Dalio, who sort of pioneered that concept. Let's see, Selka Shop Caterpillar. So now, off the open, let's continue to look at some of these alerts. There's not too many. PL. Well, the reason I might like PL is because of this trend line that it broke the other day. So last couple of days, it's sort of peeled off the bottom and is no longer being pushed down at the same rate that it was before, as defined by the trend line resistance. It is now softening up as far as that downward push goes. And you can even see that kind of beautifully in the softening volume as well. So probably this earnings release is going to catalyze something nice. Hopefully, we'll see. But I wouldn't necessarily get into it just 3 days before earnings. That would be an issue. Also, another issue on it is that it pulled back so far. It retraced about 60% of its move, which is not good, greatest relative strength. But the market has been in shambles, so you never know what still has a lot of strength. BWXT, no. IonQ, no. These are just like sort of morning alerts that are going off. Weldon or Wilden, whatever this is. This one, is definitely shaping up. I'm liking what I'm seeing. We've got some volume decreasing here. While we've got this move upward. That can mean that the interest in the stock is calming down and can make for a really beautiful sneak entry before it decides to go and do what it did before. So in the next, I don't know, month, there could be a sneak entry on Wilden coming. FTAI, Open Door. I guess Open Door is not too terrible, but as far as how much it's pulled back from highs and where it's at, it's not too terrible. But I just really don't like how scraggly is the word that I always use. Choppy back and forth, everything is on Open Door. Let me pull that up on this one here. And you can see how all the progress in the name is due to just a couple of days. So, for 6 months, all price progress has been due to about 5 days. So that's not something you really want to swing trade because you need the thing that and just like be running and drive its way up. Okay, so not Open Door. SanM. Whoops, SanM. Let's pull that up. Similar kind of problem. It's blippy and then retracey. Blip and retrace, blip and retrace. I mean, you have 1 day of progress here and then flatline for a while. 1 day of progress and then nothing more until 1 day of progress here. So I can't swing trade that. It's not useful. And I'm not going to get in here and wait a month for it to blip because that's just not how we trade. WWR pulled back way too much. This is pretty much dead. Okay, let's take off Open Door. A bat, same thing, dead. DK, I mean, let's see how it shapes up. NRG. NRG is just, where are you going to find an entry in that mess? It's impossible to trade. In fact, I'm going to take off the alert on it. It's just useless. I don't even need to know about it. Okay, we just looked at Weldon. We just looked at HIMS. HIMS broke the 200. That's not good. Broke the 200 back here. Not a good sign. We don't like that. It's going to take a while to get back into shape, at least above the prior pivot high above the 200, in order for me to say, okay, maybe now we're going sideways. And then even then, I'm going to need to see 4 points to an uptrend. So we're talking half a year minimum before we really can do anything with HIMS again. And so we don't really care about HIMS anymore. NVIDIA. NVIDIA, by the way, needs to shape up a little bit, but it's not in terrible shape. It's pretty good, but it's it doesn't look like a lot of the leaders, but it's up there, pretty nice. probably a 96% relative strength. I mean, as a matter of fact, I can look that up and see what it says. Let's see. Here, NVIDIA. And down below gives the score 97. So I said 96%. It says 97%. I actually trust myself more. So I'd go with the 96%. Okay, take that off, NVIDIA, and then Uami, no thanks. Okay, that clears everything out. Now, relative strength-wise, what's trading on the greatest dollar amount is Google. Google's the number one. Most money flowing into Google today, or out of. But the most money is being traded on Google today, and then Avgo. And the market itself, I believe, is just pulling back. Yeah, the market's pulling back, but kind of bounced. This is what I was saying. You know, we gapped up open, and now we're pulling back. But like I said, I think this whole push has been soft. This is the real volume of a push right here, right? There it is, represented. We want to see that those exact levels, $40 billion, $60 billion, represented in the volume of this push-up. And look how low it's been. It's been anemic. So this is, in my opinion, not a real push-up. This is acting, when you factor in volume, more like a pullback. Pullbacks are low volume. So if going up is a pullback, then what does that mean? What's it a pullback in? How is going up a pullback? Well, it's a pullback in a downtrend. So in downtrends, upward moves are low volume because they're pullbacks in downtrends. So, I'm very cautiously only slightly allocated in two positions right now since yesterday. Very cautiously. And, I expect that this market is kind of iffy here and hasn't really established itself yet. And I'm kind of hoping that the market pulls back on low volume and puts in that Wyckoff soft pullback retest. However, the way things have been trading, moving up on low volume, I wouldn't be surprised if the pullback was high volume. And if that's the case, then we're still in a downtrend. We're still pulling back. We may go back and double bottom if that's the case. And who knows how long it will allow itself to test that double bottom before maybe it even does another leg lower. Like, let's look at what that could look like. So we could see something like this. It bounces. We move up with a lot of hope, but we don't make it all the way to the top there. And then we come back down. We get a little bounce. Hey, I told you so. And then boom, So by February, we could potentially be making a lower low. And that's basically my prediction on that, which is not really a prediction, but my projection there. That projection, sort of like weather patterns. It could be this, it could be that. Is based on these volume signatures going on. These unmatched volume signatures. There's divergence in the volume signatures here, and so that tells me that this is a pullback. And if going up is a pullback, that means we're in a downtrend still. Even at this late date, you could, before you even get another push down, you can already predict that because the upward move is acting like a pullback because of volume. So that's kind of cool. You can sort of forecast, project, foresee where you are in the sentiment trend and which sentiment based on a little bit of the volume analysis there. But we should double check against the S&P 500 as well, although S&P 500 does mix in a ton of value stocks, a ton of staples, a ton of industrials, energy stock. It kind of really screws up the outlook on growth. But we could really check IWM, these small caps, if we really want to get an idea of, like, how is risk looking, because that's where risk starts in smalls and mids. So over here we can see that, yes, indeed, we having a low volume uh, pullback style push up after having a high volume push down. Remember, volume is your lie detector on the market. So high volume equals move is true. Low volume equals move is not true. And so, we just really, actually, all kind of volume pushes on the S&P 500 have been relatively average, even below average compared to selling volume. That hasn't changed. That hasn't changed since, back here. All of this has been misrepresented movement, off balance movement. Let's see. So let's look at the IWM and see what it looks like volume wise. So that could give us a little bit more accurate representation of how much money is flowing into risk. So money flowed heavily out of risk, and then it got heavily invested right here. Now, I would pay attention to that. To me, this looks like a huge, $20 billion, at least in IWM, the way it's indexed, $20 billion went into high risk, small caps, high risk. And that's no small deal. That's pretty important. So it means that probably this low is going to stick for a long time. And that, yes, this is a low volume push up. So it may mean that we come back down and we do some retesting, but I think we're going to see small caps remaining stronger relatively in price performance than big caps. So I think risk is, in that sense, kind of like risk is kind of on, but only when price is really favorable down in this range down here. And I think we could see, like I said, mega caps actually break down in a month or two in February. That's possible, based on volume. These things, they can change in a single day. A single day can change everything. So, there'll be people coming back later going like, you said blah, blah, blah. And, okay, well, you missed the broadcast where the very next day I said this, and I gave another projection, and it's a new projection. So, only a Sith Lord deals in absolutes, right? So, so no, and trading is that way, by the way. It's just constant, subjective, discretionary, ever-changing flow environment. By the way, this is a very cool ETF called REMX, which is rare earth metals with an X on it, making it an ETF. And it can be how you can invest in, like high power magnetic materials and rare metals for technology production, which right now are in high demand, extremely high demand, which, by the way, I think will fall off in about probably less than 3 years. This whole like hype about data centers and energy, it's going to wane. Why? Because first of all, the creation of all that, the reason why we're getting this huge push into all this is because of the advent of AI, right? And so AI is driving the need for CPU power. However, that's because AI is inefficient right now. I think you could all agree with me on that. That in layman's terms, it's very easy to say the AI is inefficient right now. It is inefficient, right? It takes a lot to get it to do a little, right? And then that includes energy wise, but also in the programming and the technology and the logic and the innovation side of it. It's inefficient. So over the next few years, however, it's going to become more efficient by orders of magnitude. And so that's going to change the demand for energy by orders of magnitude. So if AI becomes 10 times one order of magnitude more efficient, then energy drop the needs for energy drop by one order of magnitude because you can achieve the same level of result with 1/10 of the energy. And so I think that I don't think LLM is going to be the last technique for creating artificial intelligence. I think that's it's just a very, very basic substructure, substrata, and like in years, in the coming years, there's going to be much more innovations in those spaces, and you're going to find that we don't need all that CPU power, and we don't need all that energy, we don't need all the rare earth materials, we don't need all that stuff to actually have intelligence, to have artificial consciousness and artificial reasoning. And agentic, AI and all that good stuff. It's not going to be necessary. So, but that's going to have to be innovated. That's just words out of my mouth right now. But that's just the way it goes. I mean, that's evolution. That's how humans, improve everything. And eventually, I guess AI is going to be improving everything. So, uh, anyway, the long and the short of it is that yeah, there's going to be this big run up in energy, but it's going to get fucking hammered at one point. Like because all it's going to take is that one innovation. It's going to like there's going to be this one like a moment. It's not going to be like okay, we got 4% more efficient with how we compute. There's going to be a cataclysmic shift in the innovative way that AI creates the same reasoning. It's going to go from LLM to LXLM or it's going to be some other thing. They're going to put a fucking symbol in there. You know what I'm saying? And it's going to change. And that shift is going to be probably nearly an order of magnitude in difference. So you don't really like kind of invest in this stuff. You really do have to trade it, whether that's following the 50 moving average or the 200 moving average for 2 or 3 years. But once that breaks down, um, it's the beginning of the end of the top of the top. It's the beginning of the top and it's the end of the top. You know what I'm saying? So, uh, yeah. But I do believe that for the next few years, or maybe a year, maybe two years minimum, we do have runway. We do have growth runway in rare earth materials, storage like STX and WDC, and compute power. So that'd be NVIDIA, TSM, MU, all the chips, uh, and then energy. You just go to XLE. How's energy? What's the demand for energy be going? Well, well, should be going up, but yeah, there it's going up, and that those trends will continue for a while, for a year at least, if not 2 years. But mark my words. Once there's a quantum leap, if you will, in AI, um, everything changes by an order of magnitude. Around. Even if it goes 4 times. I mean, even if it got, let's say, 3 times more efficient, not 10 times, 3 times more efficient. That's a 66% cut in the energy required to produce the same result. So that means energy stocks, not not necessary anymore. Or energy use stays the same, and now AI is 3 times more efficient for the same energy result. So it can go both ways, but I think probably only super companies will continue to pay the high cost for extra high performance bleeding edge results versus the ones that are going to need to cut back but get the same results and just operate perfectly fine. Maybe they're a company that makes napkins and they just need AI to do, internal company management and stuff. And they really don't need to be bleeding edge. versus others which are probably using AI to actually innovate AI itself. And those companies are going to be pushing AI, pushing with all their energy that they can. So it's an interesting, um, runway the next few years. Um, but yeah, I was just thinking just the other day. I was just thinking just the other day. I was having a conversation with my dad, and we were just talking about like, boy, how far we've come, and just like let's make it a big number, 1,000 years, right? 1025 to 2025, like how far we've come. Like holy crap! In fact, languages have changed and evolved. I mean, like it's what a difference. And so we said, my God, can you imagine where we're going to be in 1,000 years? I mean, that is just, it's so, and in 1,000 years is not much time, like in the history, right? And yet, what we've done in 1,000 years and then projecting that out like on the same curve, it's unfathomable. It's insane. Now, just break that down to 100 years. With like the invention of steel and skyscrapers and cars and in aviation, 100 years, like 125, right? 100 years or 150, whatever, just call it a 100-year block. Where will we be in 100 years? That is also almost equally unfathomably insane. My dad was saying that in 1,000 years it's absolutely certain that we will have completely migrated across the whole solar system and be operating, you know what do they call it? Level 2 planetary society or something. Uh, you know, but 100 years. You got to understand that robotics coupled with AI increase human efficiency, or just increase evolutionary efficiency, the innovation of things, um, by a massive amount. I mean, I don't know how long it takes for a robot to charge or how hard you could slave drive them. But let's presume that a robot can work 22 hours a day, whereas a human needs, 8 hours of sleep or 5 to 8 to 10 hours of sleep. So we're offline 1/3 of our day, whereas a robot probably can do 90%, maybe 95%. So you put that on Mars, and scale it up, and shit. You could have. I mean, have you seen how fast China builds things? To get with like a lot of manpower. We could have an entire civilization on Mars in a couple of years with that kind of innovation. So it sounds, you have to be kind of, you don't want to get too outlandish because as an investor and a trader, you have to have a realistic feel for things, but you also want to be a bit of a futurist. In order to be a stock market trader, you kind of have to be. So hopefully that interests you out there, everybody, because that is a big part of what makes uh, a trader have the right instincts, and for you to gravitate towards the right things and sort of to understand how the technology has always transformed industries. Technology innovation has always transformed industry. Like we don't even use the same laundry machines 100 years ago. The technique for that was probably like a clothesline, right? Now our laundry machines have Wi-Fi and like sensors, and you know what I'm saying. So technology innovation transforms every industry eventually. And I think that Meta jumped the gun, and I think it was very risky when they jumped the gun and tried to say that VR was the next technological ramp up. The idea there was that all industries would move into VR, and we would live in a VR world, and we would go to the mall and shop walking around a VR mall and meet friends there and everything. And it just didn't happen. Again, it's sort of like solar. Solar's been this fucking, or nanotechnology. These things have been like for 50 years. they've been hype, you know, and it gets a little traction. It just never happens, but it's going to, it will. It's not the right time. Sometimes it's just not the right time, and then eventually it's just so obvious. It's just like going like that. The last domino, just boop. Yeah, we're all gonna live in VR now. Like boop, that'll happen. Just not now. Maybe in 15 years, maybe another generation away. You know. So, but or two. Who knows? But you know, you just have to have a sense for all that. You need to be tapped into things and think about everything. What do I think about RR? Let me see. I haven't done any analysis on like what they're doing. So from that perspective, I couldn't tell you. But right now, this is very bad. This pullback was extremely strong. It gave back way too much. So uh, basically, 80% of investors lost all their confidence in the company. That does clean things out. Shares were given to people down here and all throughout this sell off. And so there's a new wave of shareholders. And so then maybe that makes it go up again. But this was a bad, whatever sentiment this was, whatever did this, can it really be replaced by people who are dumber to it than that? Like, is there truly enough, replacement stupider investors to ignore, whatever caused this big pullback, to be able to push it up higher? Maybe. I don't know. It could be a small cap. I don't know. Let me see. What's the capitalization on it? Yeah, it's not even $1 billion. So probably, yeah, it probably could get pushed up by a lot of less intelligent investors and actually make a move. It probably could. But just mind you, uh, whatever is happening as far as price improvement in it is going to be less intelligent. And because of that, it's subject to freak out, panic, um, and just a lack of liquidity, a lack of capital, and also this bad sign of everyone running back here. Not good. So I mean, that's kind of like what I can tell by a chart, And I've been doing this for over 25 years, and chart reading is my specialty. So I can see a lot from a chart. Everything's on a chart. Seriously. Let's see, Remex, okay, and energy. I took that off of the alert. WDC. This is another like STX Seagate. This is Western Digital. This is a storage company. These hard drives or storage media companies, they're being the revenue is soaring. You do want to take a look at in the reports how is their efficiency though. Where can you see that as a company? Where can you see efficiency? In their margins. You want to see stable margins. You don't want to see margins all whacked around. This month, we brought in 27% because XYZ. The next month, we only brought in 3% margins because of XYZ. You don't want wild margins. You want a consistent company that is solid. And with all the different storage companies, you're going to find one that's going to have more solid margins. And that's going to be the most important thing. They're going to be the winner. So let's take a look real quick. All right, so we see here the margins back in quarter one of 25 were 7%, and then 14%, and then 33%, and then 10%, and then 41%. It's all over the fucking map. We can't really work with that. What's the matter with them? Why can't they be consistent? What's going on? Be consistent. This is why I probably like STX more. I haven't even checked their margins, but I like the STX chart more. Let's go see. Maybe STX has better margins. Maybe they don't. Let's see. I'm guessing they do. They do. They have a much more consistent 14%, 14.5%, 15.7%, and then a jump up to 20%, which they've held to 21%. So their margins are increasing, but consistently. That's pretty cool. But their revenues, I must say, are only incrementally increasing. So a lot of their bottom line earnings growth has been from improving margins. But that improving margins could be from um, uh, firing, people, and then replacing them with AI. So now if you look at the annual growth, not so good. Now let's go back to WDC. Look at the annual growth on that. Boy, annual growth is not so good there either. So, but I still prefer STX. Their margins look more consistent, and on that basis. But there's also a couple other storage companies, but those are big ones. Found you again. Hello, Abel. Let's see. How long have I been streaming? I need some water. I'll be right back, guys. And let's go take a look at the market right before I leave. Uh, yeah, so it's red. But it opened up, gapped open, so we're still well within the mid range of yesterday's day. So we haven't given back much. It's kind of a non-day, and um, the volume. I was talking about that earlier. By the end of the day, key in on the volume. See what it's like, especially sell volume days. Is the sell volume high? But just low volume in a push up in general is not good. Okay, I'll be right back. I got to grab some water. All right, I'm back. Let's go check the Twitter feed. GPT-5 generated the key insight for a paper accepted to Physics Letters B, a serious and reputable peer-reviewed journal. This is a key step in which GPT-5 proposes the main idea of the paper, completely de novo. No way. Wow. So in other words, GPT just innovated in science and published a physics letter. Wow. Paper, a physics paper. That's incredible. And what's it about? What did it innovate? Compare and contrast studies of nonlinearity and non-relativistic quantum mechanics with treatments that incorporate what is known from quantum field theory, that the nonlinearity must involve the entire wave functional, which describes a potentially infinite number of space-like separated modes. Okay, okay. And then it went on and went into it. Wow, interesting. What a time! What a time we live in. When you get the chance, can you check out hymns? I already did, and they don't look good. They're below the 200 moving average. And hers. Okay, I didn't know they're related. Hers is related to hymns. Or you were just kind of joking. There is no hers, right? I mean, I see a hers here, Hera SPA, but that's not it. You're probably just joking. But yeah, I did look at hymns, and it's below the 200 moving average, so it's not good. I mentioned that earlier. Hey, thanks for the gifting, Miles. I'm just looking at my Twitter feed. Sometimes, I follow all the kind of prominent people, in my side corner of trading, which is sort of swing trading, growth stocks. So it's always interesting to see what picks they're looking at. Like, light, I do love light, but it's hard to get in. It just keeps going. I do like it. But it's going to need some kind of base pullback for me to really start to get into it. Down here, yeah. But here, I'm going to need something to happen so I can get in here. And WDC came up as an alert. I was just saying, WDC storage, and then we got an alert on it. CEG, Constellation Energy. Yeah, energy is great right now, but this one should be a lot better, and it is not. Let's see, BE is another energy company. Yeah, that's doing really great. What's gold doing? Gold continues to be doing great, but it is acting a bit toppy now. It's reached some kind of a top, pulled back, put in a wedge drop, and it's been chopping. Anything can happen. You could say that same exact thing kind of happened right here. So anything can happen. But it just means it's probably nothing's going to happen for a while. Again, as it does. A little bit of price progress, a little bit of price progress, a little bit of price progress. You might call it a lot, but once it's over and it's hit its top, it's probably time to just get out. But that's not the way you do gold in a portfolio anyway. You want gold to be about between 5 and 10% of your portfolio. Just to sort of hedge against everything else. Lunar, not for a while, like a year and a half or 2 years, when it first kind of was landing on the moon or whatever. No, nothing good going on there. And it's beaten down to a pulp. Nope, nope, nope. We don't need to do bottom feeding. There's plenty of great stocks. Let's take a look at Robinhood. Yeah, Robinhood's doing great. Now, if you put like a trend line resistance on that, there's several ways you could do that. You have this. When is it gonna uh, break out of that particular trend line and those touch points? And then you have this one, which it recently broke out of right here. That was nice. And then you have currently whatever dynamic one is going in, which is like this, and then let's say price goes up today, it would touch higher, so then it will project out more like this. So it's currently dynamic, so it's going until it finally stops and puts in something like this. We can't know what it is, but then it will have put it in, and that whatever that trend line is, you could potentially get an entry in down there. Another way to measure the trend line pullback could be like this, and then you get in here. It's virtually the same, but the timing will be better off of whatever this one is. And of course, it may bounce and reflect off of this one, then tighten up, and then that's the ultimate. That's finally the real tasty point over there. And that's not even a full level breakout to all-time highs. So that'll be a nice early entry when it happens, wherever it happens, like at 135 instead of 152. And could create a little swing trade, in there at that time. It's gonna looks like projecting maybe mid-March or something, if we get it that way. So a lot of things are kind of like building up again. Things got reset because of the drop in the last in breadth and in the last 2 months. I think it's 2 months. Yeah. It's going to take time to mature and then create confidence and then create enthusiasm. But sometimes that can change in an instant. Enthusiasm can be created by anything, you know, global economically. I wish I knew how to invest or understand what I'm looking at. Well, you know, this is an educational program. I'm not a financial advisor, but from an educational point of view, put your money into the market. That's it. That's all. QQQ. It's called QQQ. I would recommend that, not the S&P 500. Put it in QQQ. Save. Look, spend less than you make. Pay off all your credit cards. Have no debt. Whenever you have debt, you have credit cards, so you have credit. But whenever you have money on them, pay it off right away within a day or two or three. Keep your credit cards always paid off with like a little teeny bit of balance was okay. That'll keep your credit score real high. But spend less than you make, save. Move the savings into investment, invest in the stock market. You don't have to think about it. Just put it into QQQ. You could put 5% into gold, GLD, and you could even put 30% into TLT, which is bonds, and you'd have a perfectly balanced portfolio at that point. So you put 5% into gold, 30% into TLT, and the other 65% into QQQ. And I have a very well balanced all weather portfolio, which will be resilient to corrections and crashes, and it will continue to just work your savings. And you just keep putting money into that, and you keep those allocations in that way. Like if one grows big, then the savings that you have the next month, you buy the other stuff up so that the proportions continue to remain at 5%, 30%, and 65%. 5, 30, 65. This is a modern all-weather portfolio. So there used to be something called a 60/40 portfolio, but that has been sort of superseded by the modern all-weather portfolio, which is now the sort of the best portfolio you can put together. So simple. It's like, I mean, you could have be in 7% gold and 30% TLT and 62% QQQ, and you could up the gold a little bit and this or that, but there's really no issue there. Right now, with gold being as extended as it is and as expensive and high as it is, it could be better to get a small allocation instead of a large allocation, so you don't deflate. So you don't get deflate too much. And then if that 5% allocation moves down to 4 or 3% because gold came down in price, then what I'm saying is you've saved this next month or this following 6 months or whatever, and when you go back in, you buy it back up to 5% allocation. It's called rebalancing. It sort of auto-magically uh, gets you in pullbacks on those things, and rebalances everything, and then you're just going to do outstanding. It's very hard to beat the market. You have to be a professional trader of 20 plus years experience really to consistently, long term, beat the market. In the short term, you can beat the market. Anybody can beat the market, but then you lose it all and you have to sell your Lambo and everything. So you can't rely on that. You're welcome, Gustavo. Don't forget to follow me. See you around. Or I mean, if you're hanging out, cool. Oh my goodness, I need to put on the fan. I'm starting to feel a little bit of heat in here, but we're probably almost done with the show. Also, the morning program. We could take a look at some more stocks, though. Let's take a look at the leaders on my leader list. Even though today's not an investing day, or a trading day, or an allocation day, because it's a little bit of a pullback day. It does look like we have bottomed on the day. I see things are coming back up. Bottoming tail candles being formed on the day, and it's kind of strong move up. So we may be able to allocate by the end of the day. We'll see. But I'm pretty cautious. I'm pretty cautious here, and just dipping my toes in the water. Intel is top of our list. Yeah, it looks pretty nice. Not an entry day today. PRM, Perimeter Solutions. A little slingshot alert here. This, the white candles are slingshots. Yeah, I wouldn't get in like this, like extended up like that. But it's nice to see. Oh, what was the other one that you were talking about, Diedrich? It was TTI. Let's take a look at that. TTMI also looks good. TTMI. Maybe that was the one you were talking about. But I think it was TTI. Let me take a look. TTI. But TTMI definitely looks nice too. Yeah, it probably was TTI. Oh, yeah, yeah. You got a really great entry in this right here. Very nice. In fact, it was like late, but the nice thing about the trendline alert was even late was still great. It was a pre-breakout, and what a great day! Oh man, hopefully you got in for full allocation because um, what a great entry! And when they take off like that on those days, you can't really. I mean, maybe by the end of the day, you maybe made a decision to add to full, hopefully, and then just to have a cost average right here, which would be the way to handle it. But you should have full in something like that. That's just way too good of a performance. And you might even hit 1-to-1 today or tomorrow, and really be in a good situation. That's really what you're kind of aiming for on any of these. Is just hit the 1-to-1, hit the 1-to-1, finance the stop, and then allow the thing to breathe, and then see where it goes. That's the trading method there. Instead of moving stop to break even after the 1-to-1, keep the throttle open and see where it goes. Depending on the market, it's the VIX levels and all that good stuff. Like, what is the VIX today? Yeah, the VIX is still looks like 16 something. Yeah. Well, I mean, we can look at it over here. 16.32. So anyway, let's see. Looking at other stocks. Oh, it looks like Cat. My position in Cat is now moving up about a quarter through about 0.25 R. Let's take a look. My entry. Nice. Yeah. It's nice when something that extended kind of. It's not really extended because it's in the beginning of the pullback, but boom, it's breaking out right now. This little dotted line here, I didn't draw that. That's part of a indicator that I have, which shows sort of like breakouts happening. And so anyway, now it hits all-time highs. I don't know. Maybe let's see. Yeah, all-time highs. And what happens when that happens is it goes on everybody's list, starts getting alerted. Oh my gosh, Caterpillar just hit all-time highs. The thing's on fire. It's been on such a good run lately. And meanwhile, I got in yesterday. And if you really were horny about the stock, you could have even gotten in right here on the trendline resistance break on that day at 570. Well, okay, maybe it was 575. So, but I got in at 590 and with a wider stop. The stop on that day would have been probably down here. Looks like no, you wouldn't have been stopped out. You'd have been good, but it definitely would have tested your faith a little bit. And yet, either way, things are going good. So looking good on Cat. And Shop is coming up a little bit from the bottom after having pulled back from my entry. So a little bottoming tail candle going on there as well. This little bottom down here. My candlesticks are, I call them thick wicks, fat wicks. Fat wicks, I custom program that. I like to be able to see the price action where the wick was a little bit more clearly. Just kind of mentally allows me to process the wick prices a little bit better. So I like to do that. That's why I have my candlesticks wicks look so fat like that. That's just custom programming. Over it's been 25 years been doing this, so 20 more than 25. Has it been more than 30? It's been 30 plus years that I've been doing this. So, gosh. So, I have a lot of stuff built in, a lot of preference built into what I'm looking at. But I'm constantly shifting, I'm constantly evolving and changing. Like for instance, just recently I added this where the 200 moving average line turns thick if it's been up, if it's been up sloping for at least 5 months. So at that moment, it's been up sloping for at least 5 months. That's a Mark Minervini preference, and I like to see that. Yeah, the Stitch Fix I like. I mean, it's not Stitch Fix. This fix is interesting. And we've got this kind of trend line resistance and possibly higher lows going in, creating what you might consider the right side of the pullback bull. Just like what we were just looking at. Was it Caterpillar? Yeah, no, yeah. Where you had this trend line resistance entries you could have gotten into in the early side of things. Um, but then, soon it's going to be making new all-time highs and taking off from there. That's a breakout, when that happens. There's a lot of breakout traders, but in general, there's just not enough breakout traders to always sustain a continuation from breakout. So most breakouts pull back, most of them. The minority push. Probably 80% of breakouts pull back in some way. And that's why Scotland T's fish hook uh, is useful for breakouts and EPs. So we go back to CAT, for example. Let's say I did not get in yesterday. It's breaking out to all-time highs today, and I want to get in. Well, I don't necessarily need to get in today, although I could and put my stop here. But there may be a pullback tomorrow down to here, and then another day like this down here, and then it goes up, and then finally it goes up here, and that would be an entry. That's the fish hook, like that, and that would be the entry. And at that point, you can put your stop below the pivot low or the low of that day, and get the same exact risk unit. You've been patient, and you'll be rewarded for your patience. And then it takes off from there, and it's a lot less risk and a lot more reward, especially on the probability side. All right. Let's see. How long have I been streaming? Let me double check here. It doesn't show over there. Does it show over here? Yeah, hour and 11. I think that's probably correct. Okay, I'm going to end the stream there, guys. Thanks for tuning in. But don't forget to follow, and I'll try to stream again tomorrow. I'm trying to stream every day, but it just doesn't happen. So hopefully I'll see you then. All right, thanks for tuning in, everybody, and safe trading and happy trading to you. Bye bye now.